So, what's the first thing I need to understand about retirement and taxes? Well, quite frankly, you have to know your after-tax retirement savings picture before you retire. So you have to know what that number is. And the reason I say that is because you may have $500,000 in your 401k, and that may sound like a lot, but you got to remember something. That's not all your money. That's not all your money. It's never been taxed. So what you want to know is what is the after-tax equivalent of those dollars. And I just have some examples there. If you're in the 35% tax bracket, well, that 500 really has the value of a $325,000 nest egg. Well, where did the other 175 go? Well, it went to taxes. And if you're in the 37% bracket, it's 315. So you might have 500,000, but you don't have 500,000 to spend because you have to take taxes out. And Uncle Sam is the one who makes all those rules. So you're partnering with someone who makes the rules, which is really hard to swallow for me. But that's how it works. In addition to that, if you have what's called a qualified plan, and that's a plan that basically is a 401k, IRA, 403b, anything that's been growing on a tax-deferred basis for you that you've not paid taxes on, that's a qualified plan. You will have to take distributions from that, forced income, if you will, at age 72. So you will have to take money out of that. You won't have a choice. So just some additional details on that. After-tax distributions. So if you're in the 35% tax bracket, that's this line here. It's the lowest on the chart, 12% and then 0% tax bracket. And you kind of see how the dollars work, okay? The higher bracket that you're in, the lower the amount of money you're going to have at your disposal because more money goes to taxes. Okay, but at least I still have Social Security to supplement my income and Medicare to pay healthcare costs. Well, let me share with you. They have their own tax traps as well, which I'll get into right now. So, Social Security and taxes. So let's take a look at that opening teaser I gave you. Remember that 40.7% tax rate? Well, before the concert trip, you had 38,000. After the concert trip, you had 39,000. So the actual increase in income from scenario 1 to scenario 2 was $1,000. Very straightforward. Now, this is when we start getting into some complexity. Bill got hit by what we call the Social Security tax torpedo. So what that means is that he hit a certain threshold, which incorporated more of your Social Security to be taxed than not. And so the taxable income on the right after the trip is $43,675. Before the trip, it was $41,825. That's a $1,850 difference. So if you take that $1,850 that caused was the taxable income, and you divide that by the $1,000 that was actually spent, it comes out to $1.85. So for every additional dollar of income Bill received, an additional $1.85 was added to his AGI. Pretty crazy, right? I mean, that's exactly how the code works. And that's why it increased by so much. So look at it another way. So before the concert trip, the income tax would have been $48.19. Afterwards, he's paying $52.26. So even though it went up $38,000 to $39,000, he's going to pay $407 more in tax. If I take the $407 and divide it by the $1,000, it's 40.7. That's where it comes from. So the effective marginal tax rate is 40.7, even though the stated marginal tax rate is 22%. Now that 22% comes from this chart on the left. So you see here, 41,776 to 89,075. That's where he fell in between. Okay, and that's the 22% rate. But the effective marginal tax rate was 40.7. Again, the tax torpedo. A lot of people don't even realize it. So different approaches to retirement. Folks have different ways they want to retire. I can tell you that back when my dad retired, Retirement to him meant cold turkey, stop work, and do other stuff. And now it doesn't necessarily mean that. It could, that's number one there, retire completely. Some people semi-retire or kind of scale back their hours with fewer hours in an existing job. Now, let me just share with you a couple of things. You just want to make sure if you do that and you're entitled to a pension, some pension calculators basically take the highest earnings of the last 3 to 5 years. But if you go part-time in that job, you just want to make sure that it doesn't impact your pension calculation negatively. You also want to make sure if you do kind of semi-retire, there is a threshold that most employers have that if you fall below those hours worked, you're not going to be carried by their insurance any longer. So you'd have to go out to the marketplace and get a plan. So you just want to make sure you understand how that works in your place of work and make sure that it doesn't impact what you'd otherwise be covered for healthcare coverage. Semi-retire and you move to a different position. You move to a something you're really passionate about doing. Retire and volunteer. That's yet another option. So, that said, let's talk about, working in Social Security. What's the good about that? Well, Social Security benefits are calculated using the highest 35 years of earnings. Earnings after age 62 can still increase Social Security retirement if they replace zero or lower earnings. So what I mean by that is that Social Security will always use the top 35 years. Mind you, I didn't say the top consecutive 35 years. I just said the top 35 years. So if you are working in the workforce and then you have some goose eggs, zeros, because you took time out to raise a family, and then you have work record again and you have numbers. If you work later in life and you replace any of those zeros, to the extent that you don't have a zero in any of your 35 years, your top 35 years, well, then your PIA, your primary insurance amount, is going to be higher. Why? Well, because there's not a zero being averaged into the number. If you can get those zeros out of your record, you're going to improve your number. That's the good. The bad, well, if you take Social Security early, so everyone has a full retirement age. And just to make it easy, if you're born after 1960, your full retirement age is 67. If you're born in 1957, your full retirement age is 66 and 6 months. So whatever your full retirement age is, if you retire earlier than that, your benefits could be reduced. Why? Well, because there's something called the earnings test. So, and this a lot of people aren't aware of. So if you say, let's say you'd retire, I don't know, at 63, okay, you stop work, you turn on your Social Security at 63, which you can because the earliest you can turn it on is 62. But if you turn at 63 and you decide to continue to work at another position, just remember one thing. The Social Security Administration allows you to make in 2022 $19,560. If you make more than that, they begin to decrement your benefit. Well, how? Well, $1 for benefits is reduced for every $2 you make over $19,560. So if you're in a part-time job and you make $18,000 and you're collecting your Social Security of $22,000, I just made those numbers up, but you get to keep the entire $22,000. Okay, but if you go over the $19,560, then they start to decrement your benefit. The withheld amounts are added back to your benefit calculation at your full retirement age, okay? But that does exist. And I want to make sure people know about the earnings test because many people are surprised when they start making more than the chit, I call it, the $19,560. They're surprised when they see their Social Security check get decremented. And they're like, whoa, what happened? That's what's happening, the earnings test. All right. And then the ugly. So you still pay Social Security taxes when you're working part-time, even when you work in retirement, even when you're receiving benefits and working. And incidentally, it'll only increase your benefit if the salary that you make is higher than your prior top 35 years. If the salary you make is not higher than the top 35 years, well, then you made a contribution to Social Security. Thank you very much. And you're not going to see any benefit from it because your earnings did not exceed one of the top 35 years that you had prior. If your earnings is greater, well, then you're improving your future Social Security benefit. And that's how that works. So be aware of that. All right, so Medicare and taxes. So I always find that example is usually the best thing to do. So watch out for the IRMA cliff. IRMA is not your grandmother or not your aunt. It stands for Income Related Monthly Adjustment Amount. Everyone should be aware of this. The IRMA, it is very important. Let's just look at George and Martha. They have Medicare Part B and D. They have $283,500 of modified adjusted gross income in 2020. They sell some stock and get a $1,000 gain. They owe $188 in taxes on the stock. So they basically pay $150 plus $38. It's the 18.8% tax rate, right? Well, not quite. Here's what happens. So the IRMA basically is a surcharge that you will pay on Part B and D, Boy and David, Part B and D, if you indeed make more money over a certain threshold. And the thresholds are right there on my chart. So in 2022, in the example we have, if you're married, filing jointly, and you make between $284,000 and $340,000, your total monthly premium amount is going to be $442.30. So that's $272 more than the $170 you'd otherwise pay as a result of being on Part B. Now, why is that? Well, because if you make more in retirement, more as signified by these Magi figures, you're going to pay more for your Medicare. A lot of people aren't aware of this either. And not only does it affect your Medicare Part B, but it also affects your prescription drug coverage, which is your Part D. It certainly isn't as high, but you are going to pay more monthly for that privilege to have this coverage. So how does the IRMA work? So I just said this is the 2022 numbers, and what they're doing is they're basing these salaries, okay, on what you made 2 years ago. So they're going back to 2020, and they're looking to see what did you file as part of your tax return. And depending on what that number was in 2020, you will either pay the IRMA or not in 2022. Now, in 2023, they then look at 2021. So it is a rolling type deal, a 2-year rolling type deal. So in 21, perhaps you didn't have the income you had in 20. Maybe in 20, that's when you actually left payroll and they paid out your PTO time, your vacation time, and it came to a big whopping number that threw you in a higher tax bracket. But then the following year, you're now off the payroll. You don't have those big numbers, and maybe your salary has gone down. Well, if that's the case, then maybe the IRMA is not going to be applicable to you in 2023 because 2021 was a lower number. So please be aware that it's a year-by-year thing, and they go back 2 years as far as salary goes to determine whether or not you're going to pay the IRMA. But the IRMA is alive and well, and you want to budget that into your financial plan, your healthcare costs in retirement, if indeed the IRMA is applicable to you. I go over this quite a bit with folks when they come in to have a chat with me. Okay, so the 1-year IRMA total charges $29.16. If you add that to the $188, they actually now have more than $3,000 of additional. Well, one's a surcharge. I call it a tax. It's just taking money out of your pocket. So the extra $1,000 triggered 3104, a 310% real tax rate. Crazy. I know it's crazy, but it's how our system works. That one extra $1,000 triggered the cliff, as we call it.